2008. The world was ending. Big banks collapsing, one bad headline after another, home brokers bleeding red every single day. It was the kind of scenario that made people want to sell everything and run for the hills. Because when fear takes over, the instinct is almost always the same: protect whatever's left. But there's always someone who acts differently from the herd. Amid that chaos, while everyone else was rushing for the emergency exits, Warren Buffett went against the tide. The man took billions, and invested in companies that seemed doomed, like Goldman Sachs, right in the middle of the storm. At the time, many called it madness. But a few turns later, he walked away with profits in the range of $10 billion. But you know what? The curious part of this story isn't the profit itself. What stands out is what lies behind this kind of action. Buffett didn't freeze in fear like the crowd. On the contrary, he saw their panic as a fire sale. And that's the key point. In times of terror, the market goes completely off the rails. Opportunities don't just appear for those with billions. Sometimes, the chance lies precisely in the distortion created by mass psychology. That's why, throughout this video, I want to explore some fundamental questions. What does the stark contrast between Buffett's actions and the majority's reaction tell us about the power of herd mentality in times of crisis? What cognitive biases and social incentives lead so many otherwise rational investors to make seemingly irrational decisions, like selling low, when panic takes hold? Could the falling market be less about economics and more about the spread of emotions and narratives like an infection? Can we use our understanding of these collective behavior patterns to at least avoid the most common mistakes, even without Buffett's resources or fame? So, are you ready? Let's be honest, markets don't crash just because of bad spreadsheets. Behind almost every major collapse, there's a strong psychological engine at work. Sometimes, an asset's price skyrockets completely disconnected from reality, fueled by a story that spreads like wildfire. Look at the Dutch tulip mania in the 17th century. A single bulb became worth as much as a house simply because everyone thought they could sell it for even more later. It was the rush of, I can't miss out. Years later, the dot-com bubble arrived. The American market became obsessed with the new digital economy. Profitless companies, full of promises, became stars just because of the narrative. The fear of missing out was everything. But when collective confidence vanishes, no one wants to be left holding the bag. And when that happens, the crash is fast and collective. At its core, the price was only sustained because someone believed another fool would pay even more, the greater fool theory. When the chain breaks, the party ends abruptly, and the floor disappears beneath many people's feet. Bad economic news, rising unemployment, the Fed hiking interest rates, hits the market hard. But in reality, the effect of these news items is amplified by our psychology. Daniel Kahneman and Amos Tversky, pioneers of behavioral economics, proved that the pain of losing $100 is almost twice as intense as the pleasure of gaining the same $100. This creates an almost automatic tendency. Faced with danger, most people overreact and sell, maybe even more than is rational. And it doesn't help that the media, hungry for ratings, pours fuel on this fear, amplifying the drama. The panic cycle feeds itself, and the impulse to sell becomes a domino effect. Then there are those completely off-script situations, so-called black swans, like the pandemic, 9/11, or the Black Monday of 1987, when the market plummeted more than 20% in a single trading session, accelerated by automated trading. No one predicts them, and no one knows what to do in the moment. In that vacuum of information, people look around and copy, everyone's selling, so I better sell too. This herd effect makes the panic grow even more, dragging down even what shouldn't fall and creating distortions that only those who stay cool can spot. In the end, the biggest trigger of major crashes isn't always an economic number, but this mix of shared narratives, fear, and the need to belong. The market collapses when people suddenly start doubting together. If you find it strange when the market crashes, the truth is, you should find the opposite strange. Calm is much rarer than the ups and downs. Crashes are in the market's DNA, and it's no accident. It has to do with how the human mind works, or stumbles. These highs and lows keep coming back because, deep down, human behavior doesn't change much. Investors are often guided, sometimes unwittingly, by cognitive biases, those mental shortcuts that behavioral economists like Kahneman have mapped so well. There's overconfidence in bull markets, when everything seems too easy and safe. There's anchoring, where people cling to old prices and avoid selling a depreciated asset. And there's loss aversion, which turns any bad news into a trigger for emotional decisions. Every time these patterns repeat en masse, big cycles of euphoria and panic are born. That's what makes crashes so common. They're the direct result of collective mental errors we stubbornly repeat. In the long run, Stock indices like the S&P 500 tend to recover from crashes, and many repeat this mantra to calm nerves. But this average doesn't reflect what happens to each individual investor in practice. The outcome depends on how you behave. Those who hold or buy low usually benefit from the recovery. But for those who give in to fear and sell at the bottom, the index's statistics are just cold data. Their personal story may be very different from the recovery curve on the chart. Now, there's a difference between a normal market drop, no matter how scary at the time, and a bigger problem that affects the system itself. The real danger arises when the issue isn't stock prices, but confidence in the rules and players of the game. Cases like Enron and Madoff weren't just financial frauds that caused losses. They shattered investors' trust in corporate honesty, auditors, and regulators. That kind of event undermines the system's foundation in a far more dangerous way than a normal market crash. Mistake 1. Panic selling. Selling everything when the market crashes is often a reaction to powerful loss aversion. Remember, the pain of losing is roughly twice as strong as the pleasure of equivalent gains, and social pressure to follow the crowd. It's a strong, almost biological impulse, but it usually leads to selling at the worst possible time. Mistake 2. Trying to time the bottom. Believing you can predict the exact moment the market will stop falling and start rising is a bias of overconfidence. Numerous studies show that even professional investors consistently fail at market timing. Guessing is a strategy with very low long-term success probability. Mistake 3. FOMO and following the crowd. Deciding to buy or sell just because everyone's doing it is surrendering to group pressure. Classic psychological experiments like Ash's conformity studies show this human tendency to agree with the majority, even against one's own judgment. In the market, this conformity can be costly. The antidote is critical, independent thinking. Strategy 1, dollar cost averaging, DCA. This means investing a fixed amount at regular intervals, e.g., every month, regardless of whether the market is up or down. It's a way to bypass emotion and the need to guess. You automatically buy more shares when prices are low and fewer when they're high, enforcing discipline. Strategy 2, focus on quality. During panic, good companies may be sold off alongside bad ones. Focusing on fundamental analysis, evaluating the company's actual financial health, profits, debt, cash flow, and its business, management, market, helps identify solid firms that are temporarily undervalued due to general fear rather than real problems. Strategy 3, diversification. Diversifying means not concentrating investments in one place, a single stock, one sector. It's a way to admit we can't predict everything and to hedge against unexpected risks, the unknown unknowns. If one investment tanks, others may compensate, reducing the overall impact on your portfolio. Market crashes are much more than red charts or alarming headlines. They showcase, in practice, what behavioral finance has been saying for decades. We don't make decisions in a vacuum, but are driven by shared emotions, biases, and instincts. Thinkers like Kahneman, Tversky, and Richard Thaler not only proved this in labs, but also revealed how these patterns repeat in every crisis. The market, after all, is the sum of millions of human decisions influenced by fear, greed, optimism, and panic. The contrast between the majority and figures like Buffett makes it clear. Those who understand and manage their own impulses are always one step ahead,